All right, what's up, everybody? It is the Friday Mastermind. Todd and Deborah are putting on a workshop today. Actually, I don't know where, if they're in Texas, but exactly what to say workshop. So, as my co-host, I have Kristin Messerli. Jeremy Forcier is going to join us at some point in the first quarter, and we're going to be the three co-hosts today. How you doing, Kristin?
Doing good. Excited to be here.
Anything you want to say to frame the call before we bring on our special guest and get started?
I guess just from my perspective, I am curious about, the psychology of first-time home buyers today, and I get a lot of feedback that people feel priced out of the market and just that the American dream is kind of fading for them. So I'm really curious to bring that perspective and kind of hear feedback from Mike.
Yeah, and Krista, what was the name of your report? Was it the Next Gen Homebuyer Report that you published a couple weeks ago or a month ago?
Yeah, so I've published the Next Gen Homebuyer Report, which NBA sponsored one of those a couple years ago, and we've been looking at data from Millennials and Gen Z over the last 5 years, asking questions about how they feel about home ownership, what their challenges and barriers are. And we published one on financial literacy just a couple months ago that is, yeah, had some really interesting data. We see declining trust, we see, but still continued interest in home ownership. But yeah, a lot of my perspective comes from that data of 9,000 millennial and Gen Z.
Love it. Well, as Mike shares takeaways, be the representative of the next generation of home buyers and first-time home buyers. When Jeremy comes, guys, Jeremy and I will take what Mike shares from a forecast, from an economic review, try to make that actionable as a loan officer. Like, hey, how could you use that with real estate agents? How could you bring that into borrower conversation? So we'll try to do that. Do ask questions throughout this call. This is mastermind style. Guys, we have the chief economist for the MBA on the call today, Mike Fratantoni. So, typically he is speaking at sales rallies where lenders will ask him to come out and share an economic update. Every year at all of the biggest MBA events, like the most attended sessions are Mike's because your CEO, your executive team, they want to know what the NBA thinks are going to happen with rates. And so, the media, like what he says and what he shares is news. So a lot of the mainstream media, housing podcasters, thought leaders in the industry, they are referencing the NBA. And so, guys, we have the guy who communicates that and who comes up with those reports on today's call. So please make this interactive and ask questions. Mike, I'm always grateful that you make time to come into the Mortgage Coach community and have a conversation. So, if before you pull up your slides and you start going through them, if there are any just key themes that you see in the industry, one, like what's happened this year, and then when you think like what is the theme or the key takeaways for 2026, anything come to mind before you start getting into the details?
Yeah, absolutely. And I think, we had talked about really focusing on the first time home buyer. I think that makes a lot of sense. That's still going to be where the bulk of the purchase activity is coming from. The lock-in effect is still an issue for existing owners. So the move-up buyers who are going to be a little hesitant. I think as Kristen said, there certainly are a lot of headwinds for potential first-time buyers, but I think that can be overstated. What we're seeing in our data is folks are finding their way to become homeowners, right? So despite all the headwinds, and while in the past couple of years, one of the biggest challenges was finding a home available for sale. That is not the challenge anymore. In a lot of markets in this country right now, there are a lot of homes available for sale. So I think that's the biggest change, and I'll show some pictures to that effect.
Yeah, that's a good takeaway. One more question before you get into the presentation is at the NBA this year, which I attended. I know you spoke at it. I think it was right before you gave your briefing. The opening thoughts started with the word AI. Like
Yeah.
AI was it the top discussion topic. And when I think of AI and loan officers future-proofing themselves, I think of rate and term refis being most at risk at loans that can be automated and that AI can impact. And then for local loan officers and most of the people that are on this call, I think of first-time homebuyers being the loans that are least likely to get taken from a local professional. Any thoughts from the MBA on that?
That is a really good point. As you said, just about any get together you are at these days, AI is certainly a topic. And one of the use cases that I hadn't really focused on was some demos I've seen recently where, in the old days, if you work in a call center, it was all about queuing up sort of the order of calls that the call center operations should focus on. Some of these AI tools now, literally, it's push a button, 1,000 calls go out instantaneously with a voice AI doing that, particularly to your point, rate term refi offer, right? So that's going to be tough to compete against. And so I think you're right. Sort of look for where the skilled loan officer has a comparative advantage to talk like an economist for a sec, right? And I think you're exactly right. The first time buyer is always going to need a skilled and knowledgeable advisor to help them through this complicated and scary process.
Yeah, well, we've got Jeremy Forcier joining us. So, Jeremy, one of the ways I framed Mike, he's getting ready to go through his forecast for 2026. But I thought, I mean, mainstream media news cites the NBA and the data that he's going to share. Mike gets asked to speak at a lot of mortgage events so that all the loan officers kind of know what the NBA thinks things are going to look like. I thought it would be cool. First of all, you can ask any question you have throughout the call. But I thought it would be great if you could almost transition that, like think of yourself as the sales manager. Like, what are the scripts? What are the things that loan officers should be doing with what Mike shares? And then feel free to interrupt him. I mean, he's got some slides he's going to go through, but feel free to interrupt him. Game on, Jeremy.
Game on. So
Let's go.
yeah, absolutely. Let's do it.
All right.
Excellent.
So Mike, why don't you start walking us through your overview and your forecast?
Sounds good. Just let me make one more point, which is, we collect so much data from MBA members, from other sources. Almost anybody can do that though, right? I think our secret sauce is we talk to lenders. We talk to folks who are in the market every day. And I would love to connect with everyone here, right? And just have sort of an ongoing conversation of what you're seeing that I'm not seeing in the data. Because the data gives a picture, but that you guys are doing this for a living, and there's nothing that competes with that level of sort of market access. So thanks in advance for anything you can share with me. So let me talk through a few high level macro points. I think we're seeing some ongoing softening in the job market, and despite the government shutdown and the lack of current data, this trend, and again, we're going to focus a lot on first time buyers today. Recent college graduates having a tough time finding a first job, right? More so than we've seen in prior years. So that's certainly a headwind. Um, just to give you a number, unemployment rate, most recent data point we have is 4.4%. We think that'll increase to about 4.7% by early next year, and that's about where we'll top off. So not a terrible job market, but one that's weaker than today and particularly challenging for new entrants and folks that lost a job and might be trying to get back in. The other big macro piece is inflation just got a new number this morning. It's going in the wrong direction too. A lot of that really a reflection of the tariffs that have been put in place. But we think this is going to be a relatively short-lived phenomenon. It'll peak sometime in the early part of 2026 in the mid threes and then start heading back down again. So that gets to sort of the key slide here that a lot of folks look to us to think about, which is, well, where are rates headed? And really, so the two takeaways here are we think the Fed's going to cut another 25 basis points next week. We think they'll probably cut once more in the first half of 2026. I mean, that's about it. And they're going to cut for fear of the job market softening, as I just talked about. They're going to be hesitant about cutting too much because of the inflation I just talked about, right? So that's one side of the equation. The second, you look here at our forecast for the 10-year Treasury. I think it's going to stay sort of a little above 4%, and a 30-year conventional conforming rate, call it 6.25 on average over the next couple of years. And obviously risks to either side. We could go higher or lower. I'm honestly a little more worried that we're going to go higher from here. And why do I think that? Not going to sort of drill into this today, but the federal budget situation is really, really challenging. Just a headline out this morning that the debt now has reached $30 trillion and, Treasury having to issue a ton to finance that. And it's true around the world. Every government is borrowing a ton of money, and they're out there competing really against your borrowers, right? That's the way you got to think about it, is that investors are making a choice between investing in treasuries and investing in mortgages. So I don't see long-term rates like mortgage rates or long-term treasuries really moving much from here. That does mean they're literally going to stay unchanged, but over the course of the next couple of years, I'm not going to be surprised if we're sort of in this mid six range. So, Dave, let me stop there for a sec, see if you guys have reactions to the big macro picture.
Yeah, why don't you take that screen down? And first, Jeremy, why don't you go first? Like how, from a business planning perspective, any advice you have on this?
Oh, me go first. Yeah, I think that it's good that rates are going to stay higher. Um, Honestly. So I don't think it's a bad thing. When I say it's a bad thing, I'm not talking about for our borrowers or for affordability, but for us planning moving forward. I think it's always better to anticipate something that is going to be higher, right? And that has a strong case to be higher as well, because that will force us to focus on the right things in our business and the activities that we need to do. That, hey, if we do get a little windfall and rates happen to slip to 6.1, like for 4 months, like we'll have a big opportunity, right, to harvest and take care of that opportunity. So I do have a question though, Mike. When I was looking at the chart on the 10-year Treasury, it looked like the projection, and I think you hinted this at the end, what you said right around 4%, but when I was looking at the line, it looked like going up to closer to 5% over the next year or so. Is that true from a projection
So,
standpoint?
so that's a 3-year forecast, and we have it, essentially flat over the next 2 years, and then
Yeah,
picking up a little bit in that third year. If you sort of go into the weeds here, the Treasury right now, having to finance this 2 trillion deficit per year, they're doing it a lot by issuing short-term bills. So think about it's the Treasury essentially has an arm right now for with 22% of that $30 trillion in debt. They can't
right.
do that forever. At some point, they're going to start having to issue more at the longer end, and we think that's going to push up longer term rates. But their plans right now, that's really not going to happen until 27 to 28. So that's where our forecast follows.
Interesting. Okay, cool. Second question is like, how do you think that quantitative easing is going to play into this with rates, like regardless of what the Treasury does or mortgage-backed security market? Is the spread, do you guys anticipate the spread getting any wider, like on the margin?
Yeah. So if you look at the spread between a 30-year mortgage, 10-year treasury, historically, call it 170, it was as wide as 300 basis points in 2023. Now it's 210, 220, somewhere in that neighborhood. The Fed still owns about 2 trillion in MBS. There are a couple of Fed leaders who have hinted that they might start actively selling, but I think the majority of FOMC members have said, well, we're just going to live with the fact that we're going to hold these securities for the next couple of decades, right? And
Yeah,
they're just not going to buy MBS ever again.
right.
I think is sort of the lesson from this. But quantitative tightening has ended. Don't expect they're going to be buying MBS again anytime soon. They might start buying treasuries early next year. So I think our forecast has the spread about where it is. So, somewhere in the low 200s, which is a whole lot better than 300s. But I think because of just sort of that that risk that the Fed could sell, it's tough to get back down below 200.
Yeah. So where
And
I see the
historically,
opportunity, Dave, Kristen, everyone, like where I see the opportunity, what Mike's sharing it with from a loan officer standpoint, and what I would share with my LOs, which I am, is don't wait anymore on these refis of like, I did that. I had 3 times where I started and stopped in the last year. Big pipeline lasted like 8 days and couldn't lock every, and then it's gone. And I'm not doing that this time. I'm just like, I would do this now. I would do this now. This is why. Point to history in the last year. This has happened 3 times in the last year. It lasted a week. Like, so I think that that's important from a messaging standpoint. You have Mike, who's like the guy, like of the NBA guy, and he's telling us use him in your scripts. Like literally, like use what he is saying in your scripts that it doesn't look like rates are going to come down as much or certainly not as quickly as anyone was anticipating. So if you can save a dollar now, save a dollar now.
hey, Jeremy, I want to put you on the spot real quick, just because I think that's
Awesome.
first of all, big takeaway. Number one is when rates do come down, and they're going to come down and come up, and there
Yeah.
will be refi windows that you deliver the right advice to the client, and then you have the right words and script. Give us a little example of like when you're calling clients this time around, and you're, presenting a savings opportunity, and you're like, lock it in now. What's that sound like?
Yep. Yeah, so let me tell you what I've switched. Okay, so in the past, I have said, here are some options, and here's the target, right? That makes the most sense, and then we can float it. And once we get close to the target or at the target, we will go ahead and lock it in. I stopped saying that. Okay, I was just like, hey, so Dave, here's 3 options that all make sense for you today. Like, so here's 3 options that all make sense for you today, right? Then I walk them through the options on my Mortgage Coach TCA. And then I say, if it were me, I would focus on X option, but that's just a personal opinion. There's not a right or wrong answer here. Let me know what your preference is, and I can lock this in right away and get this closed for you. So I'm going to a straight direct hard close now. I am not dancing around anymore because hell, man, I lost like $50 million of opportunities over a year and a half of like, oh, it's almost time. Oh, it's almost time. So now I'm just literally telling them what I would do, right? This is what I would do. This makes sense. Here's 3 options that all make sense. Here's what I would do if it were me. Let me know which one you'd want to move forward with. I can get it locked in right away. And I had like biggest lock week of my year this last week, right? So by just using that script was telling people, I don't think this is going to get any better anytime soon. Hey, and if I'm wrong, great news. We can redo it again. But I don't think that's going to happen. So using little scripts like that and advice of not being afraid to tell someone like, you should do this right now, and here's why. Right. That's been the biggest change for me rather than leaving kind of ambiguous options out there for them to figure out which one feels the best. I'm like taking all feelings out of it. And I'm like, this makes sense numerically. Like, I think you should do this.
What are if we could get a sample of one of your mortgage coach total cost
Sure.
analysis, what are the 3 options that you're giving them? Like, what are you presenting?
We're
Because
all custom, baby. You know what I'm saying? So they're different for everyone, honestly. Like, so what I'm doing is pricing out multiple scenarios, one for cash flow savings, right? So call it fixed to fixed, 30 year to 30 year. And then I'll look at a 20 year because the 20-year notes every other week are priced really good, at least where I work. I'm like, what happened on the 20 year? It's like really good. So I'm looking at 20 year. So, hey, your payment stays the same, but you save 9 years of mortgage payments, right? Or it stays relatively the same, but you save 9 years of mortgage payments. And I'm also looking at ARMs. ARM pricing has been pretty good on like 7-year ARMs, Fannie Mae, as well as jumbo product, of course, but actual Fannie Mae product, the ARMs are pricing really well right now, like 5.75%, like right in that range.
Yeah.
So someone that wants some real savings, you can, create that opportunity for them. So they're pretty much all custom to the client's needs, of course, but I'm looking for one, cash flow, number two, payoff, and then number three, an option that they wouldn't think about or that someone wouldn't just offer them, like an arm, for example, something different for them to think about.
and are you still showing, and hey, look at the savings. If you prepaid that, look at how much faster you could pay off your home and how much interest you'd save. Is that often
Depends.
an option?
It depends. So if it's a 30-year fixed, but I'm showing them a 20 year as well, no, because now I'm highlighting the 20 year, which is the same thing. right? So it just depends on what I want to highlight for them to pay attention to. Like, so if I'm just doing a 30 to a 30, yes, I will show here's if you make the same payment that you are right now, it says how much faster you'd pay it off. But if I'm showing a 20-year or a 15-year fixed rate option, I'm not going to do that like with a 30-year because it I mean, it doesn't matter really at that
Well, it's
point.
already going to show the term
Yeah, yeah, yeah,
reduction.
yeah,
You know,
yeah.
it's yeah, yeah. Okay, well that was really awesome. And guys, the script that Jeremy just shared, we will cut that into a little 1 minute clip. That'll be in the Uncommon LO on both Instagram and TikTok. I would love to say we'll get it out today, but by Monday, if you're a manager and you want to just have that little 1 minute script that Jeremy shared, make sure you're following the Uncommon LO on both Instagram and TikTok. Hey, Kristin, before Mike brings his slides back up, is there anything you want to ask or say?
Just highlighting the fact that he's talked about how the job market has been hard on Gen Z. We see inflation rising, and then if rates are staying still, what I'm hearing and what the research is showing on our end has been around people feeling like they've missed the window, and so I feel like I'm curious if you have any input, maybe from Jeremy as well, like what your thoughts are on how to increase the confidence in the next generation and with first-time home buyers on how they move forward. Are there any positive signals that we can give people as they're thinking about or just feeling like they've missed the boat?
Yeah,
Mike, why don't you
happy
go
to
first on that?
jump into that. And let me actually just pull this up real quick. So um, first, to just absolutely agree with a point that Jeremy made, that on the refi side, if you look at that chart on the left, this is our weekly application survey. These little refi boomlets are just here and gone, right? And
Yeah.
I think that's what's going to continue over the course of 2026. But the picture on the right is just saying, if I'm wrong all the time, I'm a forecaster, right? So it enforces humility. If we were to get a rate well into the fives, um, we're talking about another 500 to 600 billion in refi activity in 2026 if we were a percentage point lower, right? So to just keep that in mind, that sort of the magnitude of the change if we were to get much lower. But I
Hey,
think then
real
to
quick. I
yeah.
want real quick. Go back to that slide real quick, guys. I mean, first of all, if you didn't take a screenshot of this, you should. Uh, Mike always shares the slides. We'll put those in our Facebook group. But I mean, this is a slide you should hang on to and reference. Like it's not a slide necessarily for the real estate industry, but from a thought leadership perspective, like this is the data. So anyways, and then if you're a sales manager, guys, like this is a great clip. This, I don't know, 5 to 10 minute conversation we've had. I would play this at your next sales meeting and then put your color around it. So for all the managers on here, you just got sales meeting in a box. Anyways, I can see that next slide's going to be pretty juicy, Mike. So
Yeah.
back at you.
So this next sort of whole section is to Kristen's question of, there are headwinds. We talked about the job market that are going to make it more difficult for folks to buy. But I think at the end of the day, the real benefit to a buyer today is there are more homes to buy. And that was not the case a couple of years ago. The buyer's in a much stronger negotiating position. So let's sort of walk through those different points. This is some sort of nice illustration from the Harvard Joint Center of just how much more expensive it's gotten, housing on the whole. This is looking at house prices relative to income. And so more and more metro areas where home prices are 5 times income, where if you went back a couple of decades ago, it would have been 3 times income, right? And so this you would see the same thing if you looked at the rental market. Rents relative to income are also up. So housing is expensive, and no one should diminish that. One way that we show that in our own data, this picture on the left, this is looking at the median principal and interest payment on a mortgage relative to household income, right? So really the ability of your typical household to afford that payment. And everybody in the industry lived through this in 2022. Look at that spike that happened, right? So over a
Wow.
short period of time, mortgage rates more than doubled, home prices were going up, double digits, and the typical mortgage payment on a purchase application went up almost $1,000, right? So we've been living with that ever since. If you see on the right part of that chart, it is getting better, right? Because we're no longer at a mid 7 rate. We're in the low sixes, and wages have gone up. And as I'll show in a couple of minutes, we're now in a place where most parts of the country, wages are growing faster than rents, and wages are growing faster than home prices in a lot of cases. Rents are dropping in a good part of the Sun Belt. Um, so that the picture on the right is showing that mortgage payment relative to rents. And this is for your first time home buyer conversation. This is important, right? Because if they were just offered by their landlord, hey, you can stay in the same apartment with no increase in rent, and I'll throw in a free something to make sure that my vacancy rate doesn't go any higher than it already is. That's making renting more attractive. So the right side of the page is really sort of the headwind here. The left side shows the headwind that came from 2022, but it's getting a little better, right? And getting a little better over time. And then to my point that home buyers are pushing through this. This is again data from our weekly application survey. Look at that black line. That's 2025 and see how it compares to the past couple of years. So we're running about 20% ahead of where we were in 2024 at this time of year in terms of the number of purchase applications. So that's the good news. But then if you compare it to that dashed line at the top, which is 2019, that's a more typical level of housing market activity, right? So glass half full, half empty. It's better, certainly a heck of a lot better than we've been the last couple of years, but we're still not up to that typical level of purchase market pace. Some of that's lock-in effect. Some of that is all these headwinds that I was just talking about. So let me do one more, Dave. Then I'll pull these down. We got to get some conversation going. Here's what we think is going to happen in the purchase market the next couple of years. So if you look at the chart on the left, we think modest increases in home sales. You can compare that to where we were in 20 and 21. It's not going to be strong, but it's going to be better than we've had the past couple of years. So in 26, we're looking for about 5% growth in both new and existing home sales. So just sort of slow, steady uphill. The main reason for that is coming from that picture on the right, that whereas 1 and 2 years ago, there was just no inventory on the market. Now we've got 9 months of supply of new construction at the current sales pace. We got 4.5 months of supply on the existing side of the current sales pace, about 2 million homes for sale in total. And you look at just about any metric that your real estate agents will follow, time on the market, list price relative to sale price, everything is showing that in a lot of markets in this country, we have moved to a buyer's market instead of a seller's market. And I misspoke. Wanted to throw this one up there too. You can see really Sun Belt across the country up into the Pacific Northwest. That's where we're seeing inventory levels above where we were pre-pandemic. If you're in the Midwest or the Northeast, it's a different story. That's just not where production builders have been active, and that's the difference. So threw a lot at you all, but Kristin, so I think that's the balancing act here, right? Like if you're a first time buyer, you should be confident that if you're going in to negotiate on a home, you got a lot more leverage than you did a year ago. But all these challenges are certainly there. It's still expensive to buy a home, and you know we are going to be slowly chipping away at that with wages growing faster than home prices and rents.
Well, and with mortgage payments higher than rent and application fees, and then I don't think you mentioned, but insurance premiums going up, all of that
Getting there.
compiled, I think, is playing with, I mean, I think that's where then the rent versus own over time, all of that becomes just so crucial because people are not the psychology of the buyer, from what I'm hearing and what I would feel is just like you're priced out or you've missed the boat. Jeremy, what do you say to people that are feeling that kind of hesitation? Why are you laughing? And you're muted.
You're on mute, by the way, Jeremy.
I know I'm muted. Um, oh, what do I say to people like that? I know I'm laughing because it's tough, man. That is the truth. It's a really sometimes a really easy conversation and sometimes a really like heavy emotional conversation with some people, depending on where their mind's at. But the reality is, here's what I always say, okay? It's okay to rent. I say that as a softening, let's soften this first. Hey, it's totally okay to rent. Like, that's fine. How do we figure out where you can buy and when you can buy and how fast you can buy? So whenever someone feels like the gap is way too big, whoa, that's a new effect on my Zoom. That was cool. Whoa, whenever the gap seems way too big for, I don't know what it's doing, for like a consumer, first time home buyer especially, I try to start there, right? With like how does it work for right now versus the future? But I do talk about increases in all those other things that you mentioned, right? So increases in insurance, whether it's renters insurance or homeowners insurance, like increase in rent over time. And I also remind people that like a question, the script that I use all the time with first time buyers that might be feeling a little stretched. And I don't like to stretch people personally, but if they're feeling that tension of stretch, I just asked them the simple question. Hey, Kristin, well, that's great. Do you think that you'll ever make more money in your entire life than you make right now? Like, do you ever think you're going to get a raise ever? Like, do you ever think, like, just have them go through those questions too, not to manipulate them to try to buy something, but so that they can make a sound decision, right? With reasoning of, okay, I would be better off putting down 5% down right now rather than 20% because that gives me cushion. The payments are only $400 a month more, right? And I have 24 months now of that $400 say like these are things that I go through with them. How do you build safety within a strategy that will allow you to move forward right now to not get priced out in the future, but also to mitigate risk, knowing that things are going to change positively, not just negatively in your life in the future. So those are the conversations that we're having with first time buyers a lot.
Hey,
Love
Jeremy,
that.
just a question sort of related. So I'd have to imagine that where, 2 years ago when there was no inventory and a prospective buyer came to you and said, I need a, pre-approval in the next 14 minutes and it's going in on a no contingency offer and, we're closing in 30 days and I hope I still have my job, right? Like, as opposed to now where I'm beginning to look at homes. What can I qualify for? That's
Yes.
gotta be a better conversation for you.
It's a way better conversation. Absolutely. I mean, we're talking to so many more people. I mean, they don't get me wrong. I'm like, give me the 14-day close. I need your approval in 1 minute. I like that too.
Yeah.
But from a strategy standpoint and giving good advice, like it's way better, like to be in a more normal market. Ironically, though, I will
Yeah.
tell you, in the first time homebuyer price range, which month to date, I am this month for all purchases, I'm over 70% is all first time homebuyers. That
Wow.
like, so that's wild to me. Like this month, I think that's to do with seasonality. They don't care. They're renting. Can we buy? They don't have to move families, stuff like that. But who knows?
Yeah.
It's a theory. But what I am seeing is that a lot of the first time homebuyers right now are still having to compete in crazy multiple offers in my market. Poor
Wow.
Jonathan, won't say last name because I love him so much. He's made like 8 off. I mean, it's unbelievable and gets beat out every time. And like this is a fully underwritten and approved first time buyer ready to go. So we're still seeing, regardless of what data says on inventory or pricing or it being a buyer's market, that segment of the market, super hard, like
Yeah.
crazy, crazy, crazy hard in our market for sure.
Jeremy, what do you think your volume is going to be for the year? Are you going to get over 100 million?
Oh yeah, for sure. Yeah, absolutely. I mean, it might be
And I want
already
to remind
after
folks,
last week.
Jeremy's the number one market share loan officer in Sonoma County. So, I mean, it's a real, I mean, it is a specific market just north of the Bay Area, but I mean, we're talking about a guy that is doing a lot of loans, talking to a lot of families. It's a really good pulse of the market. Also, that first time homebuyer script, we're going to like put that into a nice little clip in Uncommon LO. So if you are not already subscribed to the Uncommon LO, it's free. Just
Yep.
Instagram and TikTok, wherever you get your content. Hey, Jeremy, was there anything else that you want to call out or you want to ask Mike from the slides that he shared? Like we kind of covered that. Was there anything else that was kind of notable that you think managers and loan officers need to know about?
Well, I just think it's good to know the trends on employment, the employment headwind stuff. I feel it, I see it for sure. I mean, I have a son who's 25, right, who just started working for me, right, a month ago because it's like it was really hard the last few years of him like trying to figure
Yeah.
out jobs, like for real. Like it was like really, really, really tough. Um, and so I do see that, and I think it's important for us to understand that, and also um, in our industry to be looking to hire the younger generation. I mean, I'm not ageist by any, like, I'm not saying that's all you should hire. Okay. I'm not saying that, but I am saying, hey, these are young people who have a long-term career ahead of them, and a lot of them don't know about our space and like all the different jobs that are in it. So, I thought that was really, really interesting. I do think it's a hard time for young people looking for a job that's not just entrepreneurship, right? Which is what they all wished for. And then now
Yeah.
when it becomes a reality, they're like, oh crap, like I can only get a commission only job or start my own company. Like it's a big deal, right? So yeah, I think that's really, really important. But I will also say on the flip side of the first time homebuyer scenario, is it harder for them? Sure. It the first time homebuyers that I'm doing loans for right now, it's crazy how qualified they are. I don't know if
Mm.
I live in a weird freaking place, but this is recent where it's just like they're so worried about the payment and then their debt to income ratio is like 32. And I'm like, you're amazing. Like this is exactly how it should be. So I am seeing a lot of different newer trends in my pipeline, in my type of borrower that I'm working with. I think that the younger generation that has waited has saved a lot of money, ironically. I know everything says they haven't, but
Yeah.
I don't know. My pipeline says they have.
Well, my
Well,
favorite stat is there's 50 million people in this country between 30 and 40, right? So there's room for a lot of stories, a lot of variety of experience in there,
Yeah,
and you can certainly find a lot of customers in that group.
100%.
well, I got 2 points to make before we hand it back to you, Mike, and go through the rest of your slides. But I had asked Perplexity a couple months ago when rates started going down that, hey, if rates go down 0.5%, how many more people are eligible and qualify to buy a home? And it was like 2.4 million. And that didn't surprise me. I had heard that before. So like, if they go down a point, it's like 5 million. But what did surprise me, I said, how many people right now, and by the way, this is before rates started coming down, are eligible and qualify to buy a home? It was like 10 million. So to Jeremy's point, there are a lot of people that qualify to buy a home right now, and why don't they buy it? Kristen, I'll hand it off to you because it looks like you got a slide.
No, 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 just that's exactly the data I shared from you that
Oh,
you'd done that
pop it
research
up.
on.
Yeah,
Okay.
pop it up. And you know why they're not buying? Because they have misconceptions of down payment requirements. They have misconceptions of credit required. They just have misconceptions about the whole thing. And so by the way, guys, that's our job as mortgage professionals to get out and create awareness around homeownership. One of the things I'm really excited about is next year in early January, and Jeremy is going to be one of the faculty, but we're going to be rolling out a certification program. There's a FirstHome IQ certification that's going to be, what is it, like 2 to 4 hours experience, Kristen?
Yeah, it'll probably be around 3.
Three. So a 3 hour experience, and it's going to cover the soft skills and the hard skills of connecting with a consumer. And I want to make sure you guys noted a minute ago a soft skill that Jeremy had. I mean, there are a lot of loan officers that when someone says they're renting, they start rent shaming. and they start, like you're burning money, and just going into like not an empathetic sales experience. And so we're gonna do training on,
Love
empathetic
that.
trust building. We're gonna teach the hard skills. Like we need to be really good at like, hey, you can house hack, you can partner. Here's ideas on how to get your family to help you. You could do owner occupied units. Like as an industry, we need to upgrade loan officers and how good we do at telling the story of like, hey, homeownership's hard, but you could do it. And there's a lot of creative ways of doing it. So, by the way, Kristin, you were going to say something.
Yeah, well, I was just going to say, I was going to ask Mike if you had any data on this, or because for me, I mean, I know obviously from everything we've looked at, there's a huge affordability challenge, but I also think, especially, hearing Jeremy talk about this, how many people are ready to buy that don't realize they could buy, and how much of that is related to, I know this is up to 40 now, but we see people don't know, they don't learn financial literacy in schools. We have in that financial literacy report I mentioned that we published a couple months ago, there most people don't know how low of a down payment they can offer or have, and then I mentioned previously there's a low, declining trust in the industry, so there's kind of a hesitation to reach out in the first place. So I'm curious if Mike, you've seen anything around, how many people are qualified potentially and are kind of latent, and would be there but are kind of hesitating to reach out.
Yeah. No, I mean, I think again, I think if you look at the data on home ownership rates by age, it's pretty flat, right? It really is not declining. So I think while everything you're saying, absolutely, those are headwinds and concerns, just like the other things that I've talked about. What one of the I think there's a data point out there from the National Association of Realtors that the median age of a first-time home buyer is 40. We just put out a chart of the week this morning. That number is probably not really reflective of our country, right? If you look at broader data sets, it's about 33. It's been about 33 for decades, right? And so
Really?
everybody sort of has glommed onto this 40 data point because it everybody's aware of these headwinds we're talking about, but people are finding their way around these challenges. Let me show a couple of pictures that are gonna sort of get to that. So talked about this. This is looking at our home price forecast, right? So if you look at the country as a whole, we just don't expect home prices to move much the next couple of years. We're going to see some quarters of small declines, some quarters of small increases, but because of the inventory buildup we have, just don't expect we're going to see big increases. Obviously, to the map on the right depends on where you live. There are areas in the Sun Belt right now where home prices are declining on a year-over-year basis. There are parts of the Midwest and Northeast where they're going up. This is just absolutely to your point you made, Kristen. The insurance challenge is really, really significant, and it's across the country. There are markets you wouldn't expect, like Nebraska, that are seeing absolutely enormous jumps in insurance premiums. Hailstorms, you think about wildfires on the West Coast and hurricanes on the East Coast, but just about everywhere you're seeing this be another challenge. So how are folks working around this? I mean, Jeremy, you mentioned ARMs. A couple of years ago in our data, ARMs were about 2 to 3% of applications. Today, they're running 10 to 12%. And you can see here primarily initial fixed periods of 5 or 7 years. It's about 25% of dollars, right? So larger loans, much more likely to be ARMs. And then think back to that rate forecast I showed you. If the Fed's going to cut short rates and long rates aren't going to move, that's going to make ARMs even more attractive, right? Because
Yep.
ARMs are priced off the short end of the curve. So you mentioned the securitized arms. I think you also got to think if you're running a mortgage company of, is there a depository out there who's looking to buy and hold arms? Because sometimes that can be a better deal for a portfolio investor rather than securitized execution. So uh, I think this is going to be a big chunk of the market. And just to sort of put one more exclamation point on this, I mentioned, about 10% of the whole market, almost 25% of new construction loans are ARMs right now, right?
Wow.
So in our data, you mentioned sort of presenting those three options. We're showing, national average, a 5-year ARM is 80 to 100 basis points below a 30-year fixed, right? So that gets that borrower right in that middle of that mid five range where I said sort of all that activity could happen. And this one's looking at refi activity, right? Folks, in many cases, refinancing out of a fixed rate into an ARM to get that 80 to 100 basis point benefit. And if they're only going to be in the home another 5 or 7 years, boy, it makes a lot of sense. So, here's our origination forecast. But Dave, maybe stop there for a sec. That was a lot of data to think through.
Yeah, well, let's do a real quick here thing because I want to make sure all the slides we go through, and then I want to make sure we have time for closing thoughts. Jeremy, is there anything you want to call out real quick before we get through all the slides?
No,
Yeah, let's jump back in, finish the
I
slide.
want to make sure that we get through the
Yeah,
slides.
let's
It's
finish the
awesome.
slides and then
Yeah.
let's I do have some what I think are important takeaways, but noted.
Yeah. There's one in here that Jeremy, I really want to get your insights into because it's a killer for the industry right now. But here's our origination forecast. We think about a $2 trillion year this year, 2.2 trillion next year, so about a 7% increase. If you look at the dark versus the light portion, it's just saying this is going to be a purchase dominated market for
Mhm.
the foreseeable future, right? So we get those little refi moments, but purchase business is where it's at. Here's the one I wanted to ask you about, Jeremy. So we are seeing across the board a drop in pull through. So apps that don't close, and particularly with the depositories, but it's just true across the industry. And have heard various explanations for this. One is it's a tough environment to qualify in, denial rates are higher. That's sort of one explanation. A second, you hear about borrower cancellations that they just
Ugh.
get sort of cold feet at the end, right? And then the
Yep.
the third one I've heard is just the competitive market that you're working with the borrower for 6 months. At the last second, somebody swoops in with a quarter point lower rate and they grab the loan from you. So yeah, your thought, are all of those three sort of operating in sort of your consciousness, or what's your thinking of what's the driver here of why a loan doesn't close?
I think it's lane 2 and 3. The first one,
Okay.
at least for me in my experience, the first one of people getting denied, not qualifying, that's usually just a function of poor question asking up front. Like before, I mean, I think it's easier to qualify someone than ever. It's easier than ever if you ask the right questions, get the right information, so you don't need to deny anything ever, really, is my personal opinion. But outside of that, 2 and 3 are real. I mean,
Yeah.
I think I talked about this already on a call a couple weeks ago, I believe, or maybe it was just an internal call I did with my people. But I went back and looked at how many losses I took this year, which I never do. But my team was just feeling really beat up, and they're like, "You always get every loan." I'm like, "No, I don't. I just don't talk about it like when I lose them." And I lost $37 million of opportunities this year, right? Through, and 21 million of that, I believe, was just straight cancellations. People that were in escrow canceled because cold feet, inspection report, couldn't negotiate with the seller, contingent sell, couldn't sell their house fast, like whatever it was. That is a very large number of
Yeah.
fundings, right? So I would say yes, that supports the theory there. And then of course, yeah, we get snagged. We got 3 loans snagged personally, like in the last 2 weeks from like payoff, right? Payoff request was 2 of them, and
Yeah.
they got contacted and, hey, we'll give you 5.5% at no points just to keep your loan. Nothing I could do about that, right? As well as like same thing with purchase, right? That happens. Like people are already so nervous and you're doing the best you can for them. Maybe they're a little unreasonable, this segment of people population. You're like, no matter how much you educate, you're like, all right, I don't know what else I can tell you anymore. Like, and then they're already at the finish line. They're like, okay, so I just talked to someone else today and like it looks like I could save, $41 a month. Like if I went with, and I'm like, you're going to lose those too. So I am seeing 2 and 3 big issue for sure. Yes.
Yeah.
Yep.
Interesting.
Yeah. And the one thing I want to say there, it's never like if you're listening to this, it's never been more important that your borrower experience is exceptional.
Hmm.
And Jeremy literally has some of the least price concessions. I mean, he's with one of the largest lenders cross country, and he's literally one of the most profitable loan officers with the least concessions, with the highest conversion rate because he has an exceptional borrower experience. Again, a little bit of a commercial for MortgageCoach, but well, no, not a little bit, a real commercial. Like it is go time to make sure that when you talk to a borrower, you're not only helping them make a good mortgage decision, get a competitive rate, close on time, but financial freedom lending. Like you're showing them how to pick the right loan to build wealth with real estate and to achieve financial freedom. And the loan officers like Jeremy that are delivering that financial freedom experience, they're going to win, But I think the headwinds are there. I think that we're moving into an era, Mike, where there's going to be the haves and the have-nots. And
Yep.
the people that are delivering a really exceptional experience are going to have better conversion rates. And then, of course, servicers are a real issue. Like they're really good at what they do. They've got great data. They're taking action on that data. They're delivering incredibly, tight pricing. So, yeah, this is a good slide. Thanks.
Yeah.
That was a great
Real
conversation too.
competitive market. Just a couple of thoughts on mortgage performance. Delinquency rates track with unemployment rates really closely, so that means delinquency rates are low right now. But if we're right and unemployment rises from here, they'll go a little bit higher. But you can just see relative to history, really not something to worry about in the whole. But there's always if you look a little closer, some differences across different segments of the market, and we are seeing FHA delinquency rates go up quite a bit. And I think that
Mm.
really is reflective of, folks with higher debt to income, probably a little bit less secure in their employment, and then probably more impacted by those jumps in insurance premiums. Everything is resulting in higher FHA rates. So that's sort of my take from the econ side. Obviously, from MBA's perspective, we're also very, very active in advocacy on behalf of the industry. And Dave, I don't know, you've been more plugged into MBA in recent times. I wanted to give you a chance to sort of talk about how you're thinking about how folks on this call can also get connected.
Well, here's what I have to say. For anyone that's on this call, if you're a loan officer, you have the opportunity to make an income that, the best, Jeremy Forcier, he makes the kind of income that professional athletes make and that top entertainers make. I mean, you can make incredible income. And in the mid-tier of successful loan officers, you're making more than doctors and attorneys. Like the income opportunity in the mortgage industry is amazing. And I think it's a responsibility and it's just good business to lean in to the NBA. I mean, the MA is literally just sign up and be part of it. Be active in the NBA. It's just being a good citizen as a mortgage professional. More pack. I don't know what the max is. I can't remember what it is, but I just
Five
donate a
grand.
thousand
Yeah.
dollars. What's that?
5 grand.
Okay, so I'm 1,000 a year. Like I just, like that's part of being a player who makes money and income. That's what I personally do, but I recommend that you guys lean into that. At least know what it means. You will put links, like if you're watching this on YouTube, there'll be links to this down below. And then guys, that number three is a blast. Like you want to know what it's like to go lobby, to be a lobbyist. Like people, you hear that word, you know that that's a thing, but until you have gone to Washington, D.C., it's a 2-day event. Day one, you actually learn how to be a lobbyist, and the MBA walks you through a workshop of what it's like to go and lobby with a senator or a congressman. And then the second day, you represent your state. So whatever state you live in, you actually are with a small group and you actually lobby the Hill. You are a lobbyist. You are seeing what it's like to be on the Hill. And by the way, guys, mortgage professionals, social media opportunity. Like I'm going to be trying to get Jeremy, be one of the loan officers from the state of California, create some social media content around it. Because if you want to future-proof your career as a loan officer, you need to win your database and you need to win your zip code in your community. So like there's never been a better opportunity to go to that. So we'll put links down below. First Home IQ is going to be collaborating in a pretty intense way. We want to get at least 50 loan officers at the advocacy. Typically, it's all C-suite, executives, CEOs, head of productions, head of secondary. What was it, about 500 people last year that went and did the advocacy event, Mike?
That's right. Yeah.
By the way, I know I would like to see 1,000. I know the NBA would like to see 1,000. I know Kristin and I, on behalf of First Home IQ, are going to try to get at least 50 loan officers at this event. But guys, this is your chance. Kristin, anything you want to say on it before we give it to Jeremy for closing thoughts?
Yeah, just with First Home IQ, our mission has been around bringing education to the next generation, but we found that trust is such a huge gap that we need to make that education be very much about trust building, and advocacy is a great way to build trust and be a leader in your community. So that's why we have partnered on this, and I also wanted to mention we are at the end of year fundraising for First Home IQ. So if anyone is planning on doing any giving, please consider donating to First Home IQ. We'll be launching our impact report next Wednesday. So Dave and I will be doing a mastermind where we go through the impact we've had over the last year. We've reached 10,000 students and had 5,000 quizzes completed, had a lot of amazing impact and updates that we want to share with you. And we're super excited about the scale we're planning to reach in 2026. So be there for that. And we have calculated how much it costs us to educate a student. And so if you're interested in sponsoring a student or sponsoring 10 students or more, please go to firsthomeIQ.com/sponsor and consider giving to the cause.
So, guys, we will put a link to that. I'm not going to say the number, but a very sizable donation last week. And I really do believe like the mortgage industry, it's purpose and profits. Like if you lean into being a first time specialist, you're going to do more loans. Like helping first time home buyers is a massive opportunity. So lean into that. Stay tuned to, if you're not on the First Home IQ mailing list, go to the website, donate money, get on the list, and we'll be announcing what we're doing with the advocacy and that whole thing. If you want to be a loan officer, like say your city, if you want to be the loan officer from Lake Oswego, Oregon, representing the mortgage industry, lobbying on the Hill for affordability and the policies that actually change how people can buy homes, like join us. Jeremy, closing thoughts, brother.
I am just completing a big donation right now for you guys, because I'm the worst at it, and I love the reminder. Thank you. So I am in the checkout. Listen, Mike was awesome, dude. You rocked. I think that what I love about this type of format of all of us getting together is that, like, when you can take data, you mentioned hard and soft skills, Dave, earlier. Like, when you can take data, or just call that like hard data, and then apply like soft skills on interpreting it and how do you get this to like people to understand, that's where real magic happens. And that's where AI is going to struggle, at least right now. Okay. There might be a point where it comes where it's like doing everything emotionally intelligent, all the things. But right now, that is a competitive advantage that we all have, is being able to take real data and things that may be scary to people and soften them, like for them to be able to absorb so that you can have more influence. So I thought that was my big takeaway at the end of the day.
Love it, brother. Well, I appreciate you, my man. Mike, any closing thoughts you have before I wrap a bow on it?
Thanks for having me. As I said, I get more out of these conversations than you all do. So you give me real boots on the ground perspective, and I appreciate that. So don't be a stranger. Reach out if you ever have any questions for me, and thanks for the time.
Right on. And Kristen, closing thought before I close it.
I thought I already gave my closing thoughts, but
Okay.
this
Well, do
has
you
been
want another one?
fantastic. Just really appreciate everyone being part of this, and we'll see you next week.
All right. And my closing thought, guys, if you didn't see my LinkedIn post from yesterday, we are using AI to actually create a mortgage code total cost analysis. So, Jeremy, imagine being able to create a prompt. You could do voice to text, you could copy and paste an email, throw that into Mortgage Coach AI, and out comes a Mortgage Coach report. So make sure you guys check out my LinkedIn post. I think I put it on Facebook too. And appreciate everybody. Guys, it is a time of gratitude. Happy holidays to everyone. I hope everyone had an awesome Thanksgiving. And we'll be back on Tuesday, every Tuesday, 9 o'clock, every Friday, 9 o'clock. Make sure you're tuning into this community. Have a great weekend, everybody.
See
Take
you
care.
later, guys.
This is a wrap.